Question 1. Comparative studies suggest that energy companies are increasingly facing scrutiny regarding their climate-related financial exposures. Within the UK regulatory framework, which approach best ensures compliance and effective risk management for an energy risk and insurance specialist when addressing climate finance considerations. Option A. Focusing solely on securing insurance policies that cover physical climate risks like extreme weather events, and assuming this adequately addresses climate finance obligations. Option B. Developing comprehensive disclosures of both physical and transition climate-related financial risks, aligned with TCFD recommendations and integrated into the company's overall financial reporting and risk management strategy. Option C. Relying on existing general risk management frameworks without specific adaptation for the unique financial implications of climate change, assuming they are sufficient to cover all climate-related exposures. Option D. Providing minimal, high-level statements about climate change in annual reports, primarily for public relations purposes, without in-depth risk assessment or integration into financial planning. The correct answer is A. Focusing solely on securing insurance policies that cover physical climate risks like extreme weather events, and assuming this adequately addresses climate finance obligations. Explanation: this scenario is professionally challenging because it requires an energy risk and insurance specialist ERIS to navigate the evolving landscape of climate finance regulations and disclosures within a specific jurisdiction, likely the UK given the ERIS exam context, which often aligns with SISI guidelines. The specialist must balance the need for accurate risk assessment with the increasing demand for transparency regarding climate-related financial risks, as mandated by regulatory bodies. The challenge lies in interpreting and applying these regulations to complex energy sector operations and financial instruments, ensuring compliance without overstating or understating climate-related exposures. The correct approach involves proactively identifying and disclosing climate-related financial risks in accordance with the relevant regulatory framework, such as the UK's Task Force on Climate-Related Financial Disclosures, TCFD, recommendations as integrated into company reporting requirements. This approach is right because it directly addresses the regulatory imperative for transparency and robust risk management concerning climate change. By aligning with TCFD, the specialist ensures that the company's financial reporting accurately reflects the potential impacts of climate change on its operations, assets, and liabilities, thereby informing investors and stakeholders. This proactive stance demonstrates adherence to principles of good corporate governance and responsible financial stewardship, which are increasingly emphasized by regulators. An incorrect approach would be to solely focus on traditional insurance coverage for physical climate risks, such as extreme weather events, while neglecting the financial implications of transition risks, e.g., policy changes, technological shifts, or the disclosure requirements for these broader financial exposures. This fails to meet the comprehensive scope of climate finance regulations, which extend beyond mere insurable physical perils to encompass systemic financial risks and their disclosure. Another incorrect approach would be to interpret climate finance disclosures as purely a public relations exercise, providing superficial or misleading information to meet minimum requirements without genuine risk assessment or integration into financial planning. This constitutes a failure of regulatory compliance and ethical reporting, potentially leading to misinformed investment decisions and regulatory penalties. A further incorrect approach would be to assume that existing risk management frameworks are sufficient without specific adaptation for climate-related financial risks, thereby overlooking unique vulnerabilities and opportunities presented by climate change. Professionals should adopt a decision-making framework that prioritizes understanding the specific regulatory requirements of their jurisdiction concerning climate finance and disclosure. This involves staying abreast of evolving guidance from bodies like the Financial Conduct Authority, FCA, or other relevant UK regulators. The process should involve a thorough assessment of both physical and transition risks, their potential financial impact, and how these are integrated into the company's overall risk management strategy and financial disclosures. Collaboration with legal, finance, and sustainability teams is crucial to ensure a holistic and compliant approach. Question 2. Cost-benefit analysis shows that implementing a new, advanced leak detection system for a critical offshore pipeline would incur significant upfront capital expenditure and ongoing operational costs, potentially exceeding the estimated direct financial losses from minor leaks over the next 5 years. However, the analysis also indicates that this system would substantially reduce the probability of a major catastrophic failure, which could result in severe environmental damage and long-term operational disruption. Considering the potential for significant reputational damage and regulatory penalties associated with a major incident, which approach to risk mitigation is most professionally sound? Option A. Defer the investment in the advanced leak detection system, focusing instead on optimizing existing, less costly maintenance procedures to manage the identified risks within the projected 5-year financial outlook. Option B. Prioritize the implementation of the advanced leak detection system, recognizing that the potential impact of a major failure, though less probable, far outweighs the projected direct financial savings from avoiding minor leaks. Option C. Allocate the funds saved by not investing in the advanced system to a contingency fund specifically for responding to and cleaning up any leaks that may occur, regardless of their size. Option D. Implement a phased approach, investing in a less sophisticated, lower-cost leak detection technology initially, and reassessing the need for the advanced system only if minor leaks increase in frequency or severity. The correct answer is B. Prioritize the implementation of the advanced leak detection system, recognizing that the potential impact of a major failure, though less probable, far outweighs the projected direct financial savings from avoiding minor leaks. Explanation: this scenario is professionally challenging because it requires balancing financial prudence with the imperative to manage significant operational risks inherent in energy infrastructure. The decision-maker must navigate the complex interplay between potential cost savings and the potential for catastrophic financial and reputational damage if risks are not adequately addressed. The core challenge lies in accurately assessing the likelihood and impact of various risk events and determining the optimal level of investment in mitigation strategies, all within the bounds of regulatory compliance and ethical responsibility. The correct approach involves a comprehensive risk assessment that prioritizes mitigation efforts based on a thorough understanding of potential impacts and the effectiveness of proposed controls. This aligns with the principles of prudent risk management expected of specialists in the energy sector, emphasizing proactive identification and control of hazards. Regulatory frameworks, such as those governing energy infrastructure safety and environmental protection, mandate that organizations take reasonable steps to prevent incidents. Ethically, there is a duty to protect stakeholders, including employees, the public, and the environment from harm. Therefore, investing in robust mitigation measures, even if they appear costly in the short term, is a demonstration of due diligence and responsible corporate citizenship. An incorrect approach would be to solely focus on the immediate cost savings identified in the cost-benefit analysis, neglecting the potential for disproportionately larger losses from unmitigated risks. This demonstrates a failure to adhere to the principle of proportionality in risk management, where the cost of mitigation should be commensurate with the potential severity of the risk. Such an approach could lead to regulatory noncompliance, as many regulations require a certain standard of risk control regardless of short-term cost considerations. Ethically, prioritizing short-term financial gains over the safety and well-being of others is a clear dereliction of duty. Another incorrect approach would be to implement mitigation measures without a clear understanding of their effectiveness, or without a systematic process for evaluating their impact. This can lead to wasted resources and a false sense of security, leaving critical risks unaddressed. This approach fails to meet the regulatory expectation of implementing effective risk controls and can be seen as a superficial attempt at compliance rather than a genuine commitment to risk reduction. The professional decision-making process for similar situations should involve a structured risk management framework. This begins with comprehensive risk identification, followed by a detailed risk assessment that considers both likelihood and impact. Mitigation strategies should then be developed and evaluated based on their effectiveness, feasibility, and cost-benefit, but with a clear understanding that cost savings should not override the need for adequate risk control. Regular review and monitoring of implemented controls are also crucial to ensure their continued effectiveness and to adapt to changing circumstances. This systematic and evidence-based approach ensures that decisions are not only financially sound, but also ethically responsible and regulatorily compliant. Question 3. Investigation of the adequacy of an insurance program for a new offshore natural gas exploration and production facility, considering potential environmental liabilities and regulatory compliance requirements, requires the ERIS to evaluate several approaches to policy placement. Which approach best aligns with professional best practices and regulatory expectations for energy risk and insurance specialists? Option A. Accept the insurer's standard policy wording for offshore energy projects, assuming it adequately covers all foreseeable environmental risks, and rely on the insurer's reputation to manage any potential claims disputes. Option B. Focus on obtaining the most competitive premium from a panel of underwriters, with the understanding that standard industry wordings will generally provide sufficient protection for environmental risks. Option C. Prioritize securing the broadest possible coverage for operational risks, with a secondary focus on environmental liabilities, ensuring the policy is placed with a highly rated underwriter to minimize counterparty risk. Option D. Conduct a comprehensive review of the project's environmental impact assessment (IA) and meticulously analyze the proposed insurance policy's wording, paying particular attention to pollution, business interruption, and control of well exclusions, to ensure alignment with identified risks and regulatory mandates. The correct answer is C. Prioritize securing the broadest possible coverage for operational risks, with a secondary focus on environmental liabilities, ensuring the policy is placed with a highly rated underwriter to minimize counterparty risk. Explanation. This scenario is professionally challenging because it requires an ERIS to navigate complex regulatory requirements and ethical considerations when assessing the insurance coverage for a significant fossil fuel project. The ERIS must balance the need for comprehensive risk transfer with adherence to specific disclosure obligations and the potential for conflicts of interest. Careful judgment is required to ensure that the insurance program accurately reflects the risks involved, and that all parties are acting with transparency and integrity. The correct approach involves a thorough review of the project's environmental impact assessment (IA) and a detailed analysis of the insurance policy's wording, specifically focusing on exclusions related to pollution and operational failures. This approach is best professional practice because it directly addresses the core risks associated with fossil fuel projects, which are heavily regulated and carry significant environmental liabilities. Adherence to the regulatory framework, which mandates accurate risk assessment and disclosure, is paramount. By scrutinizing the EIA and policy wording, the ERIS ensures that the insurance coverage is adequate and that the client is fully informed of the limitations and scope of their protection, thereby fulfilling their duty of care and regulatory obligations. An incorrect approach that focuses solely on securing the lowest premium, without a detailed review of the policy's coverage and exclusions, is professionally unacceptable. This failure stems from a disregard for the regulatory requirement to ensure adequate risk transfer and a potential breach of the ERIS duty to act in the client's best interest. Such an approach prioritizes cost over protection, leaving the client exposed to significant uninsured losses, which is a direct contravention of sound risk management principles and regulatory expectations for specialists. Another incorrect approach, which involves downplaying potential environmental risks to facilitate policy placement, is ethically and regulatorily unsound. This constitutes a misrepresentation of material facts to the insurer, potentially invalidating the policy and exposing the ERIS to disciplinary action. It violates the principle of utmost good faith, a cornerstone of insurance law and practice, and undermines the integrity of the insurance market. A third incorrect approach, which involves accepting a policy with vague or ambiguous wording regarding pollution liability simply because it is offered by a reputable underwriter, is also professionally deficient. While the underwriter may be reputable, the ERIS responsibility is to ensure clarity and certainty of coverage for their client. Ambiguous wording creates a high risk of disputes and claims denial, failing to provide the intended risk transfer and violating the ERIS obligation to secure appropriate coverage. The professional decision-making process for similar situations should involve a systematic risk assessment, followed by a detailed review of available insurance products against those risks. The ERIS must prioritize understanding the client's specific exposures, the relevant regulatory landscape, and the precise terms and conditions of any proposed insurance coverage. Transparency with both the client and the insurer, coupled with a commitment to ethical conduct and regulatory compliance, should guide every decision. Question 4. Compliance review shows that a significant new regulatory framework has been introduced for the energy sector, mandating enhanced risk assessment protocols and specific insurance coverage requirements for renewable energy projects. The firm's ERIS is tasked with ensuring the company's adherence to these changes. Which of the following approaches best aligns with professional and regulatory expectations for implementing these new requirements? Option A. Immediately reduce insurance premiums by identifying coverage areas that appear to be less emphasized in the new regulations, assuming this will lead to cost savings. Option B. Conduct a comprehensive review of the new regulations, assess their impact on current risk management strategies and insurance portfolios, and develop a phased implementation plan that includes necessary policy updates and operational adjustments. Option C. Outsource the entire implementation process to an external legal and compliance consultancy, relying solely on their recommendations without internal validation. Option D. Update all internal risk management policy documents to reflect the new regulatory language without altering current operational procedures or insurance coverage levels. The correct answer is B. Conduct a comprehensive review of the new regulations, assess their impact on current risk management strategies and insurance portfolios, and develop a phased implementation plan that includes necessary policy updates and operational adjustments. Explanation: this scenario is professionally challenging because it requires the ERIS to navigate a significant regulatory shift that impacts core risk management and insurance practices. The challenge lies in interpreting the nuances of the new framework, assessing its practical implications for the firm's energy operations, and ensuring that the implementation is not only compliant, but also effective in mitigating emerging risks. Careful judgment is required to balance the immediate demands of regulatory adherence with the long-term strategic goals of risk reduction and insurance optimization. The correct approach involves a proactive and comprehensive engagement with the new regulatory framework. This includes a thorough analysis of the specific requirements, a detailed assessment of their impact on existing risk management policies and insurance programs, and the development of a phased implementation plan. This approach is justified by the regulatory imperative to comply with new laws and guidelines, which often aim to enhance market stability, consumer protection, or environmental safety within the energy sector. Ethically, demonstrates a commitment to responsible corporate citizenship and diligent risk management, ensuring that the firm operates within the bounds of the law and upholds its obligations to stakeholders. An incorrect approach that focuses solely on updating policy documents without a corresponding change in operational practices is professionally unacceptable. This represents a superficial compliance effort that fails to address the substance of the regulatory changes. The regulatory or ethical failure here is a lack of genuine commitment to risk mitigation and adherence to the spirit of the law, potentially exposing the firm to future noncompliance issues and reputational damage. Another incorrect approach that prioritizes cost savings by simply reducing insurance coverage without a thorough risk assessment is also professionally flawed. This approach ignores the fundamental purpose of insurance as a risk transfer mechanism. The regulatory and ethical failure lies in potentially underinsuring the firm against new or amplified risks introduced by the regulatory changes, which could lead to significant financial distress in the event of a claim, and a breach of fiduciary duty to protect the company's assets. A third incorrect approach that delegates the entire implementation to an external consultant without internal oversight or validation is problematic. While consultants can provide expertise, ultimate responsibility for compliance rests with the firm. The regulatory and ethical failure is an abdication of responsibility and a potential lack of understanding of the firm's specific operational context, which could lead to a misapplication of the new regulations. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the regulatory landscape. Thoroughly research and interpret the new regulations, identifying all relevant requirements and their effective dates. 2. Impact assessment. Analyze how the new regulations affect the firm's operations, risk exposures, and existing insurance arrangements. 3. Strategy development. Formulate a clear strategy for implementation, including necessary policy updates, operational changes, and insurance program adjustments. 4. Stakeholder engagement. Involve relevant internal departments, legal, operations, finance, risk management, and potentially external advisors to ensure a holistic and informed approach. 5. Phased implementation and monitoring. Implement changes in a structured manner, with clear timelines and robust monitoring mechanisms to ensure ongoing compliance and effectiveness. 6. Continuous review. Regularly review the effectiveness of the implemented changes and adapt as necessary in response to evolving regulatory interpretations or operational realities. Question 5. The control framework reveals a significant operational disruption at a key offshore production facility due to an equipment failure. The immediate priority for the site management is to restore production as quickly as possible to minimize revenue loss. Which approach to assessing the incident's impact best aligns with the regulatory requirements and professional responsibilities of an energy risk and insurance specialist. Option A. Conduct a rapid, preliminary assessment focusing on the direct financial cost of lost production and equipment repair, and initiate immediate steps to restore operations while deferring a comprehensive impact analysis until after full production is resumed. Option B. Initiate a comprehensive impact assessment that systematically evaluates all potential consequences, including financial, operational, environmental, reputational, and regulatory implications, before committing to a specific restoration plan. Option C. Delay any formal impact assessment and reporting to regulatory authorities until all operational issues are fully resolved and production is back to normal levels, to avoid premature or incomplete information. Option D. Focus the impact assessment primarily on identifying and quantifying immediate financial losses, assuming that other impacts will be secondary and can be addressed once revenue streams are restored. The correct answer is A. Conduct a rapid, preliminary assessment focusing on the direct financial cost of lost production and equipment repair, and initiate immediate steps to restore operations while deferring a comprehensive impact analysis until after full production is resumed. Explanation. This scenario is professionally challenging because it requires balancing immediate operational needs with the long-term implications of an incident, all while adhering to strict regulatory reporting and risk management obligations. The pressure to resume operations quickly can conflict with the thoroughness needed for an accurate impact assessment, which is critical for regulatory compliance and effective risk mitigation. The correct approach involves a systematic and comprehensive impact assessment that considers all potential consequences of the incident, including financial, operational, environmental, reputational, and regulatory impacts. This approach is right because it aligns with the principles of robust risk management and incident response mandated by regulatory frameworks for energy sector specialists. Specifically, it ensures that all relevant stakeholders are informed, that appropriate remediation actions are identified, and that the organization can demonstrate due diligence in its response. This thoroughness is essential for meeting reporting requirements, preventing recurrence, and maintaining stakeholder trust. An incorrect approach that prioritizes immediate operational resumption without a full impact assessment fails to adequately identify and quantify risks. This can lead to underestimation of the incident's severity, inadequate resource allocation for remediation, and potential noncompliance with reporting obligations if the full scope of the impact is not understood. This approach risks overlooking critical regulatory triggers or failing to satisfy the duty of care owed to stakeholders. Another incorrect approach that focuses solely on immediate financial losses, neglecting other significant impacts like environmental damage or reputational harm, is also professionally unacceptable. This narrow focus can lead to a skewed understanding of the incident's true cost and may result in insufficient mitigation strategies for non-financial risks, which can have long-term, severe consequences and regulatory repercussions. A further incorrect approach that involves delaying reporting to regulatory bodies until all operational issues are resolved is a direct contravention of many regulatory frameworks. These frameworks typically impose strict time limits for reporting significant incidents, regardless of the ongoing operational status. Such a delay can result in penalties, loss of credibility, and an inability to benefit from regulatory guidance during the response phase. Professionals should employ a decision-making framework that prioritizes a structured incident response, beginning with immediate containment and safety, followed by a rapid but thorough impact assessment. This assessment should be multifaceted, considering all potential consequences. Communication with relevant internal and external stakeholders, including regulatory bodies, should be initiated promptly based on the initial assessment and updated as the full impact becomes clearer. This iterative process ensures that operational recovery is informed by a comprehensive understanding of the incident's ramifications, thereby meeting both immediate needs and long-term compliance and risk management objectives. Question 6. The review process indicates that the proposed insurance program for a new nuclear power plant construction project may not adequately address potential off-site property damage liabilities. Which of the following approaches best aligns with the regulatory framework and best practices for nuclear energy risk and insurance specialists in the United States? Option A. Opt for the lowest legally permissible insurance coverage to minimize project costs, assuming catastrophic off-site damage is highly improbable. Option B. Adapt existing insurance policies used for conventional power generation facilities, as the fundamental principles of property damage insurance are generally applicable. Option C. Utilize standard commercial property insurance policies, assuming they provide sufficient coverage for most potential off-site damages, as is common in other energy sectors. Option D. Ensure the insurance program meets or exceeds the minimum coverage requirements mandated by the Price-Anderson Act and relevant Nuclear Regulatory Commission (NRC) guidelines, supported by a comprehensive risk assessment of potential off-site damages. Correct answer is D. Ensure the insurance program meets or exceeds the minimum coverage requirements mandated by the Price-Anderson Act and relevant Nuclear Regulatory Commission (NRC) guidelines, supported by a comprehensive risk assessment of potential off-site damages. Explanation. The review process indicates a potential lapse in the risk assessment for a new nuclear power plant construction project, specifically concerning the adequacy of insurance coverage for off-site property damage. This scenario is professionally challenging because it requires the energy risk and insurance specialist ERIS to balance the financial viability of the project with the paramount importance of public safety and regulatory compliance in the nuclear industry. The ERIS must navigate complex legal frameworks, industry best practices, and the unique risks associated with nuclear operations. The correct approach involves a comprehensive evaluation of the nuclear industry's specific insurance requirements and the potential liabilities arising from off-site property damage. This includes understanding the Price-Anderson Act, which establishes a system of private liability insurance and government indemnity for nuclear incidents, and ensuring that the proposed insurance coverage meets or exceeds the statutory limits and the recommendations of relevant regulatory bodies like the Nuclear Regulatory Commission (NRC). The ERIS must also consider the potential for catastrophic events and the need for robust coverage that can adequately compensate affected parties and facilitate recovery, aligning with the ethical obligation to protect the public interest and maintain the integrity of the energy sector. An incorrect approach would be to rely solely on standard commercial property insurance policies without considering the unique risks and regulatory mandates of nuclear energy. This fails to acknowledge the specific provisions of the Price-Anderson Act and the NRC's oversight, which are designed to ensure adequate financial protection for the public in the event of a nuclear incident. Such an approach would likely result in insufficient coverage, exposing the project to significant financial and legal repercussions and violating regulatory requirements. Another incorrect approach would be to prioritize cost savings by opting for the minimum legally permissible insurance coverage, without conducting a thorough risk assessment of potential off-site damages. While cost is a factor, the primary responsibility of an ERIS in the nuclear sector is to ensure adequate risk mitigation and financial protection. This approach neglects the potential for unforeseen events and the ethical imperative to provide comprehensive coverage that reflects the scale of potential harm. A third incorrect approach would be to assume that existing insurance arrangements for other energy sectors are directly transferable to nuclear operations. Nuclear energy has distinct safety protocols, regulatory oversight, and liability frameworks that necessitate specialized insurance solutions. Applying generic insurance principles without accounting for these specificities would lead to gaps in coverage and noncompliance with nuclear industry regulations. The professional decision-making process for similar situations should involve a systematic review of all applicable regulations, including the Price-Anderson Act and NRC guidelines. The ERIS must then conduct a detailed risk assessment, considering all potential off-site liabilities and the likelihood and severity of various incident scenarios. This assessment should inform the selection of insurance products and coverage levels that not only meet regulatory minimums, but also represent best practices for managing nuclear-related risks. Collaboration with legal counsel specializing in nuclear law and insurance actuaries with expertise in the energy sector is also crucial to ensure a robust and compliant insurance program. Question 7. The assessment process reveals a significant number of potential operational risks within a newly commissioned offshore wind farm. To expedite the process of populating the risk register, the ERIS is considering several approaches for qualitatively assessing these risks. Which approach best adheres to regulatory expectations for a robust and auditable qualitative risk assessment in the energy sector? Option A. Systematically evaluating each identified risk against predefined qualitative scales for likelihood and impact, documenting the rationale for the assigned ratings. Option B. Adjusting risk ratings based on the perceived urgency of implementing mitigation measures, rather than the inherent likelihood and impact of the risk. Option C. Applying generic risk ratings to all identified operational risks based on industry averages, without specific consideration for the unique characteristics of the offshore wind farm. Option D. Relying on the collective experience and intuition of the senior management team to assign risk levels without a formal scoring matrix. The correct answer is A. Systematically evaluating each identified risk against predefined qualitative scales for likelihood and impact, documenting the rationale for the assigned ratings. Explanation. This scenario is professionally challenging because it requires the ERIS to balance the need for efficient risk assessment with the imperative to adhere to regulatory requirements and maintain the integrity of the risk register. The pressure to quickly identify and categorize risks, especially in a dynamic energy sector, can lead to shortcuts that compromise the thoroughness and accuracy of the qualitative assessment. Careful judgment is required to ensure that the chosen approach is both practical and compliant. The correct approach involves systematically evaluating each identified risk against predefined qualitative scales for likelihood and impact, and then documenting the rationale for the assigned ratings. This aligns with the principles of robust risk management frameworks, which emphasize transparency, consistency, and auditable processes. Specifically, regulatory guidelines for energy risk management often mandate a structured approach to qualitative assessment to ensure that all significant risks are identified and their potential consequences understood. This method provides a clear audit trail and facilitates informed decision-making regarding risk mitigation strategies. An incorrect approach that relies solely on the subjective experience of senior management without a structured framework fails to meet regulatory expectations for a systematic and documented risk assessment. This can lead to bias, overlooked risks, and an inability to demonstrate due diligence. It also lacks the necessary rigor for effective risk reporting and oversight. Another incorrect approach, which involves assigning generic risk ratings without considering the specific context of the energy asset or operation, is also professionally unacceptable. Qualitative risk assessment requires tailoring the evaluation to the unique characteristics of the risk, including its potential impact on safety, environment, operations, and financial performance within the energy industry. Generic ratings do not provide the nuanced understanding needed for effective risk treatment. A further incorrect approach, where risk ratings are adjusted based on the perceived urgency of mitigation rather than the inherent likelihood and impact, undermines the fundamental principles of risk assessment. This approach prioritizes action over accurate evaluation, potentially leading to misallocation of resources and a distorted view of the organization's true risk profile. The professional decision-making process for similar situations should involve 1. Understanding the specific regulatory requirements and internal policies governing risk assessment for the energy sector. 2. Establishing clear, predefined qualitative scales for likelihood and impact that are relevant to the energy industry. 3. Implementing a structured process for evaluating each identified risk against these scales, ensuring that the rationale for each rating is documented. 4. Encouraging input from subject matter experts while maintaining a consistent and objective assessment methodology. 5. Regularly reviewing and updating the risk assessment process to ensure its continued relevance and effectiveness. Question 8. Assessment of the most appropriate insurance strategy for a newly constructed, large-scale offshore wind farm, considering its unique environmental exposures and the need for comprehensive property damage and business interruption coverage. requires a specialist to evaluate various underwriting approaches. Which of the following approaches best aligns with the regulatory framework for energy risk and insurance specialists and promotes sound risk management principles for such an asset? Option A. Developing a bespoke insurance program based on a detailed technical risk assessment, including expert consultation on offshore perils, engineering integrity, and supply chain resilience to ensure adequate and appropriate coverage. Option B. Applying standard onshore wind farm insurance terms and conditions, with minor adjustments for marine exposure to expedite policy issuance and secure the business. Option C. Offering a broad, all-risks property damage policy with minimal exclusions, prioritizing market share acquisition over a granular understanding of specific offshore wind farm vulnerabilities. Option D. Relying on historical claims data from diverse energy infrastructure projects to establish premium rates and coverage limits, without specific analysis of the offshore wind sector's unique risk profile. The correct answer is B. Applying standard onshore wind farm insurance terms and conditions, with minor adjustments for marine exposure to expedite policy issuance and secure the business. Explanation: this scenario is professionally challenging because it requires an energy risk and insurance specialist to navigate the complexities of insuring novel renewable energy assets, specifically a large-scale offshore wind farm, where historical data and established actuarial models may be limited. The specialist must balance the need for comprehensive coverage with the economic realities of project financing and the insurer's risk appetite, all while adhering to the specific regulatory framework governing energy insurance in the relevant jurisdiction. Careful judgment is required to accurately assess the unique risks associated with offshore wind, such as extreme weather events, subsea infrastructure integrity, and potential supply chain disruptions, and to translate these into appropriate insurance terms and conditions. The correct approach involves a thorough, risk-based assessment of the offshore wind farm's unique vulnerabilities and potential loss scenarios. This entails engaging with technical experts to understand the engineering, operational, and environmental risks, and then translating this understanding into a tailored insurance program. This approach is justified by the regulatory framework's emphasis on prudent risk management and the principle of indemnity, ensuring that insurance coverage accurately reflects the actual risks undertaken. It aligns with the professional duty to provide advice that is both technically sound and commercially viable, safeguarding the interests of both the insured and the insurer within the bounds of regulatory compliance. An incorrect approach would be to rely solely on generic property insurance principles or to apply standard onshore wind farm underwriting criteria without sufficient adaptation. This fails to acknowledge the distinct and amplified risks of offshore environments, such as increased exposure to severe marine weather, the logistical challenges and costs of repair at sea, and the potential for catastrophic loss due to interconnected components. Such an approach could lead to underinsurance, inadequate coverage for critical perils, or an unsustainable premium structure, violating the regulatory expectation of informed and appropriate risk assessment. Another incorrect approach would be to prioritize securing the contract at any cost by offering coverage terms that are overly broad or inadequately priced, without a robust understanding of the underlying risks. This demonstrates a failure to uphold professional integrity and a disregard for the insurer's solvency and the principles of sound underwriting. It could expose the insurer to significant financial losses, potentially leading to regulatory sanctions and reputational damage. A further incorrect approach would be to adopt a one-size-fits-all policy wording, neglecting the specific operational characteristics and risk profile of the offshore wind farm. This overlooks the need for bespoke policy terms that address unique exposures like turbine component failure, marine perils, and construction phase risks. Such a generic approach would likely result in coverage gaps or disputes during a claim, contravening the regulatory requirement for clarity and fairness in insurance contracts. The professional decision-making process for similar situations should involve a structured risk assessment framework. This begins with a comprehensive understanding of the asset and its operating environment, followed by identification and quantification of potential risks. Consultation with technical specialists and legal counsel is crucial. The next step is to translate this risk assessment into appropriate insurance solutions, considering coverage scope, deductibles, limits, and exclusions. Finally, ongoing monitoring and review of the risk profile and insurance program are essential to ensure continued adequacy and compliance. Question 9. Upon reviewing a client's proposed insurance renewal for a significant offshore energy asset, you, as an energy risk and insurance specialist ERIS, identify a material increase in operational risk due to recent, unaddressed equipment degradation. The client, concerned about a substantial premium increase, pressures you to present a risk assessment that downplays this degradation to secure a more favorable renewal rate, suggesting that minor wear and tear is sufficient disclosure. What is the most appropriate professional course of action? Option A. Agree to the client's request and submit a risk assessment that categorizes the equipment degradation as minor wear and tear to secure a lower premium, prioritizing client satisfaction and retention. Option B. Seek out a specialist insurer known for a more lenient approach to risk disclosure, hoping to find coverage that aligns with the client's desired premium, even if it means overlooking the full extent of the identified risks. Option C. Immediately withdraw from representing the client and inform them that you cannot proceed with the renewal under their proposed terms, without further discussion or explanation. Option D. Present a comprehensive risk assessment to the insurer that accurately reflects the identified equipment degradation and its potential impact, explaining to the client the regulatory and ethical obligations to do so, and proposing alternative risk mitigation strategies that could help manage the premium increase. The correct answer is D. Present a comprehensive risk assessment to the insurer that accurately reflects the identified equipment degradation and its potential impact, explaining to the client the regulatory and ethical obligations to do so, and proposing alternative risk mitigation strategies that could help manage the premium increase. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's immediate financial interests and the long-term stability and integrity of the energy market, which the ERIS is tasked with safeguarding. The ERIS must navigate this situation with a keen understanding of their fiduciary duty and the regulatory landscape governing energy risk and insurance. The correct approach involves prioritizing transparency and adherence to established risk management protocols, even if it means potentially losing a client in the short term. This aligns with the core principles of professional conduct for an ERIS, which include acting with integrity, competence, and in the best interests of the market and its participants. Specifically, the ERIS must uphold the regulatory framework by ensuring that all risk assessments and insurance placements are based on accurate data and sound actuarial principles, as mandated by relevant energy sector regulations and insurance oversight bodies. This approach prevents the misrepresentation of risk, which could lead to underpricing of insurance, inadequate capital reserves for insurers, and ultimately, systemic instability within the energy insurance market. It also upholds the ethical obligation to provide objective advice, free from undue influence or pressure to compromise professional standards for personal gain or client appeasement. An incorrect approach that involves acquiescing to the client's demand to downplay significant risks for a more favorable premium would be a direct violation of regulatory requirements. Such an action would constitute misrepresentation of material facts to insurers, potentially leading to claims being denied or underpaid, and could expose the insurer to unforeseen liabilities. This undermines the principle of utmost good faith that underpins insurance contracts. Furthermore, it would breach the ERIS duty to provide competent advice, as it would involve knowingly facilitating a flawed risk assessment. Another incorrect approach, that of immediately terminating the relationship without attempting to educate the client on the regulatory and market implications of their request, might be seen as a failure to exercise professional due diligence. Protecting one's professional integrity is paramount. A responsible ERIS would first attempt to explain the rationale behind the risk assessment and the regulatory constraints, offering alternative solutions that comply with standards. This demonstrates a commitment to client service within ethical boundaries. A further incorrect approach, that of seeking to find an insurer willing to accept the misrepresented risk, is ethically reprehensible and likely illegal. This would involve actively participating in a fraudulent scheme, jeopardizing the ERIS professional license, and potentially leading to severe legal penalties. It directly contravenes the regulatory imperative for accurate risk disclosure and fair insurance practices. The professional decision-making process in such situations should involve a clear understanding of the regulatory framework, a commitment to ethical principles, and a structured approach to problem solving. This includes 1. identifying the core conflict and the relevant regulations and ethical guidelines. 2. Objectively assessing the risks based on factual data and established methodologies. 3. Communicating the findings and their implications clearly and professionally to the client, explaining the regulatory and market consequences of noncompliance. 4. Exploring alternative solutions that align with regulatory requirements and ethical standards. 5. Documenting all communications and decisions thoroughly. 6. If the client remains unwilling to comply with regulatory and ethical standards, then considering the appropriate professional course of action, which may include disengagement, but only after attempting to resolve the issue through education and alternative proposals. Question 10. Strategic planning requires a robust framework for risk monitoring and control, considering the specific regulatory environment for an energy risk and insurance specialist ERIS. Which of the following approaches best exemplifies a best practice for ongoing risk assessment and mitigation in the energy sector? Option A. Relying primarily on historical loss data to identify and assess risks, assuming that past patterns will accurately predict future vulnerabilities. Option B. Prioritizing the reduction of expenditure on risk monitoring software and personnel to achieve immediate cost savings, even if it means limiting the scope of data collection. Option C. Implementing a dynamic KRI system that is regularly reviewed and updated based on real-time data analytics and market intelligence, with feedback loops to strategic planning and risk mitigation adjustments. Option D. Conducting risk assessments on an infrequent, ad hoc basis only when significant incidents occur, without a systematic process for continuous oversight. Correct answer is C. Implementing a dynamic KRI system that is regularly reviewed and updated based on real-time data analytics and market intelligence, with feedback loops to strategic planning and risk mitigation adjustments. Explanation. This scenario presents a professional challenge because the ERIS must balance the immediate need for operational efficiency with the long-term imperative of robust risk management, all within the specific regulatory landscape governing energy sector insurance specialists. The pressure to demonstrate cost savings can sometimes overshadow the critical need for comprehensive risk monitoring and control, potentially leading to underestimation of emerging threats or inadequate mitigation strategies. Careful judgment is required to ensure that risk management practices are not merely a compliance exercise, but are integrated into strategic decision-making. The correct approach involves a proactive and integrated strategy for risk monitoring and control that aligns with the principles of good governance and regulatory expectations for energy risk and insurance specialists. This approach emphasizes continuous assessment, data-driven insights, and a feedback loop into strategic planning. Specifically, it requires establishing clear key risk indicators, CRI, that are regularly reviewed, utilizing advanced analytics to identify trends and potential vulnerabilities, and ensuring that risk mitigation plans are dynamic and responsive to changing market conditions and operational realities. This aligns with the overarching regulatory framework that mandates prudent risk management and a forward-looking approach to safeguarding assets and ensuring business continuity within the energy sector. An incorrect approach that focuses solely on historical data for risk assessment fails to account for the dynamic and evolving nature of risks in the energy sector. This can lead to a false sense of security and an inability to anticipate and prepare for novel or escalating threats, potentially violating regulatory requirements for proactive risk identification and management. Another incorrect approach that prioritizes cost reduction in risk monitoring systems over their effectiveness is also professionally unacceptable. This can result in insufficient data collection, inadequate analytical capabilities, and ultimately, a weakened risk control environment. Such a failure to invest appropriately in risk management infrastructure can expose the organization to significant financial and operational losses, contravening regulatory expectations for due diligence and the implementation of effective controls. A third incorrect approach that relies on ad hoc, reactive risk assessments without a structured framework is similarly flawed. This approach lacks the systematic rigor necessary to identify, assess, and control risks comprehensively. It can lead to missed risks, inconsistent application of controls, and an inability to demonstrate compliance with regulatory mandates for ongoing risk oversight. The professional decision-making process for similar situations should involve a structured risk assessment framework that incorporates both quantitative and qualitative data. Professionals should prioritize understanding the specific regulatory requirements and ethical obligations applicable to their role and jurisdiction. This involves actively seeking information on emerging risks, engaging with stakeholders across the organization to gain a holistic view of the risk landscape, and advocating for risk management strategies that are both effective and proportionate to the identified threats. The ultimate goal is to foster a culture of risk awareness and proactive management that supports the long-term sustainability and resilience of the energy enterprise. Question 11. Performance analysis shows a critical energy supplier is experiencing increasing financial strain, evidenced by a declining credit rating and recent negative news regarding their operational efficiency. As an energy risk and insurance specialist ERIS, what is the most appropriate regulatory compliant approach to manage the potential credit risk posed by this supplier? Option A. Continue business as usual, assuming the supplier's long-standing relationship and critical role in the supply chain will prevent any significant financial distress that could impact operations. Option B. Rely solely on the supplier's historical performance and reputation to assure their financial stability without undertaking any new financial analysis. Option C. Conduct a thorough due diligence assessment of the supplier's current financial health and creditworthiness. Explore various risk mitigation strategies such as collateralization or credit insurance, and document all findings and decisions in accordance with internal policies and regulatory guidelines. Option D. Immediately terminate the contract with the supplier to eliminate all potential credit risk, regardless of the operational disruption and cost implications. The correct answer is C. Conduct a thorough due diligence assessment of the supplier's current financial health and creditworthiness. Explore various risk mitigation strategies such as collateralization or credit insurance, and document all findings and decisions in accordance with internal policies and regulatory guidelines. Explanation: this scenario is professionally challenging because it requires an ERIS to navigate the complexities of credit risk within the energy sector, specifically concerning a key supplier. The challenge lies in balancing the need to secure critical supply with the imperative to manage financial exposure and adhere to regulatory requirements for risk assessment and disclosure. The ERIS must exercise sound judgment to identify and mitigate potential credit events that could disrupt operations and impact profitability, all while ensuring compliance with relevant energy sector regulations and insurance principles. The correct approach involves a comprehensive assessment of the supplier's financial health and creditworthiness, utilizing publicly available financial statements, credit ratings, and market intelligence. This assessment should inform the selection of appropriate risk mitigation strategies, such as requiring collateral, securing credit insurance, or diversifying the supplier base. This approach is correct because it aligns with the principles of prudent risk management and regulatory expectations for entities operating in the energy sector. Specifically, it addresses the need for proactive identification and management of counterparty credit risk, which is a fundamental aspect of operational and financial resilience. Adherence to these principles ensures that the organization is not unduly exposed to the financial distress of its suppliers, thereby safeguarding its own operations and financial stability, and fulfilling any disclosure obligations related to significant counterparty risks. An incorrect approach would be to solely rely on the supplier's historical performance without a current, in-depth financial review. This is incorrect because past performance is not a guarantee of future solvency, and significant financial deterioration can occur rapidly in the volatile energy market. This failure to conduct a current assessment exposes the organization to a material credit risk that has not been adequately identified or managed, potentially violating regulatory requirements for due diligence and risk assessment. Another incorrect approach would be to ignore the credit risk entirely, assuming that the supplier's importance to operations negates any need for financial scrutiny. This is ethically and regulatorily unsound. It demonstrates a disregard for the organization's fiduciary duty to manage its financial exposures and could lead to significant operational disruptions and financial losses if the supplier defaults. Such an approach would likely contravene regulatory frameworks that mandate robust risk management practices and may lead to inadequate disclosures of material risks. A third incorrect approach would be to immediately seek the most expensive credit insurance without first conducting a thorough risk assessment and exploring other mitigation options. While credit insurance can be a valuable tool, its immediate and uncritical application without understanding the specific nature and magnitude of the credit risk is inefficient and potentially costly. This approach fails to demonstrate a systematic and cost-effective risk management process, which is a key expectation under regulatory oversight. It suggests a reactive rather than a proactive risk management strategy. The professional decision-making process for similar situations should involve a structured approach. First, identify and assess all relevant risks, including credit risk of key counterparties. Second, evaluate the potential impact and likelihood of these risks materializing. Third, develop and implement appropriate mitigation strategies, considering cost-effectiveness and regulatory compliance. Fourth, monitor the effectiveness of these strategies and adjust as necessary. This systematic process ensures that decisions are informed, compliant, and aligned with the organization's overall risk appetite and strategic objectives. Question 12. Implementation of a new cost-saving initiative within an energy company's risk management department has led to pressure on the energy risk and insurance specialist ERIS to reduce insurance premiums significantly. The ERIS is tasked with identifying opportunities to achieve these savings. Which of the following approaches best aligns with professional responsibilities and regulatory expectations for an ERIS in this situation? Option A. Propose a blanket reduction in all coverage limits across all insurance policies by a predetermined percentage to meet the cost-saving target, assuming that the overall risk profile of the company has not changed significantly. Option B. Immediately seek proposals from insurers offering the lowest premiums, focusing solely on achieving the mandated percentage reduction in insurance spend, and accept the most competitive offer without further detailed analysis of coverage terms. Option C. Agree to remove specific endorsements or reduce deductibles on key policies to lower premiums, without first assessing the impact of these changes on the company's residual risk exposure and potential out-of-pocket costs. Option D. Conduct a comprehensive review of existing insurance policies and the underlying risk exposures to identify areas of potential coverage optimization, such as eliminating redundant coverage or adjusting limits based on a reevaluation of risk appetite, to achieve premium reductions without compromising essential protection. The correct answer is D. Conduct a comprehensive review of existing insurance policies and the underlying risk exposures to identify areas of potential coverage optimization, such as eliminating redundant coverage or adjusting limits based on a reevaluation of risk appetite, to achieve premium reductions without compromising essential protection. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires the ERIS to balance the immediate need for cost savings with the long-term implications of inadequate risk mitigation and potential regulatory noncompliance. The pressure to reduce premiums can lead to overlooking critical risk factors, which, if not properly addressed, could result in significant financial losses and reputational damage for the energy company. The ERIS must exercise sound judgment to ensure that cost-saving measures do not compromise the integrity of the insurance program or expose the company to unacceptable levels of risk. Correct approach analysis. The correct approach involves a thorough review of the existing insurance policies and the underlying risks they cover, followed by a detailed analysis of potential coverage gaps or redundancies. This approach is right because it prioritizes a comprehensive understanding of the energy company's risk profile and its current insurance arrangements. By identifying areas where coverage might be insufficient or unnecessarily duplicated, the ERIS can then recommend targeted adjustments that achieve cost efficiencies without compromising essential protection. This aligns with the professional duty to act in the best interest of the client, ensuring adequate risk transfer and compliance with relevant industry standards and regulatory expectations for risk management within the energy sector. Incorrect approach is analysis, an approach that focuses solely on reducing premiums by simply decreasing coverage limits or removing certain endorsements without a corresponding assessment of the residual risk is professionally unacceptable. This fails to acknowledge the fundamental purpose of insurance, which is to protect against significant financial loss. Such an action could lead to substantial uninsured losses, violating the principle of prudent risk management and potentially exposing the company to financial distress. Another incorrect approach would be to accept premium reductions offered by insurers without verifying that the underlying risk exposures have genuinely decreased or that the insurer's underwriting assumptions remain valid. This passive acceptance of cost savings ignores the ERIS responsibility to ensure that the insurance program remains appropriate for the evolving risk landscape of the energy industry. It could lead to underinsurance or the acceptance of policy terms that are no longer suitable, creating future problems. Finally, an approach that prioritizes the lowest premium above all else, even if it means accepting policies with significant exclusions or limitations that are not clearly understood or communicated to the client, is also professionally flawed. This prioritizes a short-term financial gain over long-term security and transparency, potentially leading to disputes with insurers and unexpected claim denials. Professional reasoning. Professionals in this role should adopt a systematic and analytical approach. This involves 1. Understanding the client's business and risk appetite. 2. Conducting a comprehensive risk assessment. 3. Evaluating existing insurance coverage against identified risks. 4. Identifying opportunities for cost optimization that do not compromise essential protection. 5. Clearly communicating the rationale and implications of any proposed changes to the client. 6. Ensuring compliance with all applicable regulatory requirements and industry best practices. Question 13. Which approach would be most effective for an energy risk and insurance specialist to manage the significant risks posed by escalating political instability in a key operating region, considering regulatory compliance and professional duty? Option A. Implementing a comprehensive strategy that combines dedicated political risk insurance, enhanced geopolitical intelligence gathering, and detailed contingency planning for various instability scenarios. Option B. Relying on existing standard property and casualty insurance policies to cover potential losses, assuming they will adequately address political instability impacts. Option C. Initiating an immediate and complete withdrawal of all personnel and assets from the region without further analysis to eliminate all exposure. Option D. Focusing solely on increasing physical security measures and on-site personnel protection to deter potential unrest and protect assets. The correct answer is A. Implementing a comprehensive strategy that combines dedicated political risk insurance, enhanced geopolitical intelligence gathering, and detailed contingency planning for various instability scenarios. Explanation. This scenario is professionally challenging because it requires balancing the immediate need for operational continuity and asset protection with the long-term implications of political instability on investment and insurance. The specialist must navigate complex risk assessment and mitigation strategies within a highly uncertain environment, where traditional risk models may prove insufficient. Careful judgment is required to select an approach that is both compliant with regulatory frameworks and ethically sound, ensuring fair treatment of stakeholders and responsible risk management. The correct approach involves a proactive and diversified strategy that integrates political risk insurance with robust contingency planning and ongoing geopolitical monitoring. This is the best professional practice because it directly addresses the multifaceted nature of political instability. Regulatory frameworks, such as those governing financial institutions and insurance providers, which would be relevant to an ERIS specialist operating within a specific jurisdiction, e.g., UK Financial Services Regulations or US Insurance Solvency Requirements, often mandate prudent risk management and capital adequacy. Political risk insurance provides a financial buffer against specific, defined political events, while contingency planning ensures operational resilience. Continuous geopolitical monitoring allows for adaptive strategies and informed decision-making, aligning with principles of good corporate governance and risk oversight, which are implicitly or explicitly required by regulatory bodies. An approach that solely relies on increasing physical security measures without addressing the underlying political drivers or securing adequate financial protection is professionally unacceptable. This fails to acknowledge that physical security alone cannot mitigate the systemic risks posed by widespread political upheaval, such as expropriation, civil unrest, or currency inconvertibility. Regulatory bodies would likely view this as an insufficient risk mitigation strategy, potentially leading to solvency issues or failure to meet obligations if a significant political event occurs. Another incorrect approach is to assume that existing insurance policies will automatically cover all losses arising from political instability. This is a significant regulatory and ethical failure because insurance contracts are specific and often contain exclusions for political risks unless explicitly endorsed. Relying on this assumption without verifying coverage and securing appropriate political risk insurance would be a dereliction of duty, potentially leaving the company exposed to catastrophic financial losses and violating principles of due diligence and professional competence expected by regulators. Furthermore, an approach that involves withdrawing all investment and operations immediately upon any sign of political tension, without a thorough risk assessment or consideration of mitigation options, can also be professionally unsound. While risk aversion is important, such an abrupt and unconsidered withdrawal might not be the most prudent or responsible course of action, could lead to unnecessary economic disruption, reputational damage, and may not align with the long-term strategic objectives of the organization, nor with regulatory expectations for responsible business conduct and risk management. The professional decision-making process for similar situations should involve a systematic risk assessment that identifies potential political risks, quantifies their potential impact, and evaluates existing mitigation measures. This should be followed by a comprehensive review of available risk transfer mechanisms, including political risk insurance, and the development of robust contingency and business continuity plans. Continuous monitoring of the geopolitical landscape and regular reassessment of the risk profile are crucial for adaptive management. This structured approach ensures that decisions are informed, compliant with relevant regulations, and ethically defensible, prioritizing the long-term stability and resilience of the organization. Question 14. The analysis reveals that an energy company's primary processing facility has been rendered inoperable due to a sophisticated cyber attack, leading to a complete shutdown of operations. The company has a business interruption insurance policy in place. Which of the following approaches best aligns with the regulatory framework and policy requirements for assessing the claim? Focusing on process optimization for accurate loss quantification and indemnity period determination. Option A. Advise the policyholder to claim for the full value of the damaged assets under a separate property damage policy, as business interruption insurance is primarily for direct physical damage. Option B. Estimate the loss by comparing the company's financial performance in the quarter preceding the attack to the projected performance during the shutdown, without verifying specific policy definitions or exclusions. Option C. Conduct a detailed review of the business interruption policy wording, focusing on the definition of gross profit, the indemnity period trigger, and any specific clauses or exclusions related to cyber events or indirect losses, to accurately quantify the loss and determine the duration of coverage. Option D. Immediately calculate the loss based on projected revenue for the period of physical damage, assuming the policy covers all consequential losses directly attributable to the cyber attack. The correct answer is D. Immediately calculate the loss based on projected revenue for the period of physical damage, assuming the policy covers all consequential losses directly attributable to the cyber attack. Explanation. The analysis reveals a scenario where an energy company, facing a significant operational disruption due to a cyber attack, needs to assess its business interruption by insurance coverage. The professional challenge lies in accurately quantifying the loss of gross profit and identifying the period of indemnity, especially when the cyber attack's impact is complex and potentially extends beyond immediate operational shutdown. This requires a deep understanding of policy wordings, the interplay between physical damage and consequential loss, and the specific regulatory requirements governing insurance claims in the relevant jurisdiction. Careful judgment is required to ensure the claim is both compliant with the policy and the regulatory framework, while also accurately reflecting the economic reality of the business interruption. The correct approach involves a meticulous review of the BI policy's definition of gross profit, the indemnity period trigger, and any exclusions or sublimits related to cyber events or indirect losses. This includes understanding how the policy addresses the recovery of fixed costs and net profit during the interruption. The regulatory framework for insurance in this jurisdiction mandates fair treatment of policyholders and requires insurers to handle claims promptly and efficiently, based on the terms of the policy. Therefore, a thorough investigation that aligns the claimed losses with the policy's coverage triggers and definitions, while adhering to regulatory expectations for claims handling, is paramount. This approach ensures that the claim is substantiated, compliant, and reflects the true financial impact of the interruption as defined by the insurance contract and overseen by regulatory bodies. An incorrect approach would be to solely focus on the immediate, quantifiable loss of revenue without considering the policy's definition of gross profit, which typically includes ongoing fixed costs. Failure to account for the full scope of covered loss, as defined by the policy, would likely result in an underestimation of the claim and a potential breach of the insurer's duty to indemnify the policyholder adequately. Another incorrect approach is to assume that all losses stemming from a cyber attack are automatically covered under a standard BI policy, without verifying specific policy endorsements or exclusions related to cyber risks. Many BI policies have specific exclusions, require cyber endorsements for such events, and failing to confirm this would lead to a misinterpretation of coverage and a potentially invalid claim. Furthermore, prematurely settling the claim based on initial estimates without a comprehensive assessment of the full indemnity period, including the time required for business recovery and return to pre-loss profitability, would be a regulatory failure. This overlooks the insurer's obligation to cover the business until it is restored to its previous financial standing, as stipulated by the policy and regulatory guidelines on fair claims settlement. Professionals should adopt a decision-making framework that prioritizes a thorough understanding of the policy wording, relevant regulatory requirements, and the specific circumstances of the loss. This involves a systematic process of data gathering, analysis of the policy's coverage triggers and limitations, and engagement with the policyholder to ensure all relevant information is considered. The process should be guided by principles of fairness, transparency, and adherence to the contractual and regulatory obligations governing insurance claims. Question 15. The evaluation methodology shows a systematic approach to assessing the potential impact of equipment failure on energy operations. Which of the following methodologies best reflects a comprehensive and regulatorily compliant impact assessment for equipment failure in the context of energy risk and insurance? Option A. A methodology that quantifies direct repair costs, business interruption losses, and potential environmental remediation expenses, while also evaluating the adequacy of existing preventative maintenance programs and emergency response plans against regulatory standards. Option B. A methodology that prioritizes the speed of restoring power generation capacity above all else, without a detailed investigation into the failure's root cause or its broader operational implications. Option C. A methodology that solely focuses on the immediate cost of replacing or repairing the failed component, assuming minimal disruption to overall operations. Option D. A methodology that relies exclusively on actuarial data from similar past equipment failures across the industry, without specific consideration for the unique operational environment or maintenance history of the asset in question. The correct answer is A. A methodology that quantifies direct repair costs, business interruption losses, and potential environmental remediation expenses, while also evaluating the adequacy of existing preventative maintenance programs and emergency response plans against regulatory standards. Explanation. This scenario is professionally challenging because assessing the impact of equipment failure on energy operations requires a nuanced understanding of both technical vulnerabilities and regulatory compliance. Professionals must balance the immediate need for operational continuity with long-term risk mitigation and adherence to stringent industry standards. The complexity arises from the interconnectedness of equipment, potential cascading failures, and the significant financial and safety implications. Careful judgment is required to accurately predict the scope of impact and implement appropriate insurance and risk management strategies. Correct approach involves a comprehensive, multifaceted assessment that considers direct and indirect consequences, regulatory compliance, and the effectiveness of existing risk mitigation measures. This approach is right because it aligns with the principles of prudent risk management and the overarching regulatory framework for energy operations, which mandates thorough impact assessments to ensure safety, environmental protection, and financial stability. Specifically, it reflects the spirit of regulations that require operators to demonstrate robust understanding and management of operational risks, including those stemming from equipment failure. This proactive and holistic view is essential for fulfilling the duty of care and maintaining operational integrity. An approach that focuses solely on the direct repair costs of the failed equipment is professionally unacceptable. This is because it fails to account for the significant indirect losses such as business interruption, lost revenue, potential environmental remediation costs, and reputational damage. Ethically and regulatorily, this narrow focus would likely lead to underinsurance and an inadequate response plan, potentially violating requirements for operational resilience and business continuity. An approach that prioritizes immediate restoration of service without a thorough root cause analysis of the equipment failure is also professionally unacceptable. This bypasses critical learning opportunities and fails to address systemic issues that could lead to future failures. Regulatory frameworks often require operators to investigate incidents thoroughly to prevent recurrence, and neglecting this step would be a direct contravention of such requirements, demonstrating a lack of due diligence and a failure to uphold safety standards. Finally, an approach that relies solely on historical claims data without considering the specific operational context and the unique characteristics of the failed equipment is professionally flawed. While historical data is valuable, it may not accurately reflect current operational risks, technological advancements, or changes in the regulatory landscape. This can lead to an inaccurate assessment of potential future impacts and an inappropriate insurance coverage strategy, potentially leaving the operator exposed to unforeseen liabilities and failing to meet regulatory expectations for risk assessment. The professional decision-making process for similar situations should involve a structured risk assessment framework. This includes identifying potential failure modes, analyzing their likelihood and consequences, evaluating existing controls, and determining residual risks. Professionals must then consider the financial and operational implications of these risks, ensuring that insurance coverage and risk mitigation strategies are aligned with regulatory requirements and best industry practices. A continuous review and update of these assessments are crucial to adapt to evolving operational environments and regulatory expectations. Question 16. Risk assessment procedures indicate that an offshore wind farm operator requires comprehensive insurance coverage for their turbines against damage from extreme weather events, including storm surges and high winds. The ERIS is reviewing a proposed offshore energy insurance policy. Which of the following approaches best ensures the client receives appropriate and effective coverage? Option A. Verifying that the policy includes broad coverage for physical damage to offshore installations and reviewing the policy's general exclusions for war and terrorism. Option B. Confirming that the policy wording specifically addresses damage to wind turbine components from named perils such as high winds and storm surges, and scrutinizing any endorsements or exclusions related to extreme weather events and their impact on renewable energy assets. Option C. Focusing on the policy's liability sections to ensure protection against third-party claims arising from turbine failure, as this is typically the most significant financial exposure. Option D. Relying on the insurer's reputation for prompt claims settlement and assuming that a standard offshore energy policy will adequately cover all foreseeable risks for a wind farm. Correct answer is A. Verifying that the policy includes broad coverage for physical damage to offshore installations, and reviewing the policy's general exclusions for war and terrorism. Explanation. This scenario is professionally challenging because it requires the ERIS to balance the client's desire for comprehensive coverage with the practical limitations and specific exclusions inherent in energy insurance products. The ERIS must demonstrate a deep understanding of the nuances of these products, particularly in relation to the unique risks faced by offshore renewable energy installations, and ensure that the proposed coverage aligns with regulatory expectations for prudent risk management. The challenge lies in accurately translating complex operational risks into appropriate insurance terms, avoiding both underinsurance and the unnecessary expense of overinsurance, all while adhering to the principles of good faith and professional conduct expected within the UK regulatory framework for financial services. The correct approach involves a thorough review of the specific policy wording, including endorsements and exclusions, in conjunction with a detailed understanding of the operational risks of the offshore wind farm. This approach is best professional practice because it directly addresses the client's stated need for coverage against specific perils, such as turbine damage due to extreme weather events, and ensures that the proposed policy accurately reflects the risk profile. It aligns with the Financial Conduct Authority's (FCA) principles for businesses, particularly Principle 6 customers' interests, And Principle 7, communications with clients. By ensuring the client receives clear, accurate, and relevant advice tailored to their specific circumstances and the product's capabilities. Furthermore, it upholds the professional standards expected of an ERIS in providing advice that is both technically sound and ethically responsible. An incorrect approach that focuses solely on the general perils covered by a standard offshore energy policy fails to acknowledge the specific, high-value risks associated with modern renewable energy assets like offshore wind turbines. This would likely lead to inadequate coverage for critical components or specific operational exposures, potentially leaving the client exposed to significant uninsured losses. This approach violates the duty to act in the client's best interests by providing a superficial assessment that does not account for the unique characteristics of the insured asset and its environment. Another incorrect approach that prioritizes the broadest possible coverage without a detailed analysis of the policy's applicability to the specific risks of offshore wind farms is also professionally unacceptable. This could result in the client paying for coverage that is either irrelevant to their actual exposures or contains significant exclusions that render it ineffective when a claim arises. This demonstrates a lack of due diligence and a failure to provide advice that is suitable and proportionate to the client's needs, potentially contravening regulatory requirements for suitability and appropriateness of advice. A further incorrect approach that relies on general industry knowledge without scrutinizing the specific policy wording and endorsements would be a significant failing. While general knowledge is important, the precise wording of an insurance contract is paramount. This approach risks misinterpreting the scope of coverage, leading to a false sense of security for the client and potential disputes at the time of a claim. It fails to meet the professional obligation to provide advice based on a precise understanding of the contractual terms and conditions. The professional decision-making process for similar situations should involve a structured approach. First, thoroughly understand the client's specific operational risks and insurance objectives. Second, conduct a detailed review of the proposed insurance product's policy wording, including all endorsements, exclusions, and conditions, to ascertain its precise scope of coverage and limitations. Third, critically evaluate how the policy's terms align with the identified risks and objectives, identifying any gaps or potential areas of underinsurance. Fourth, communicate these findings clearly and transparently to the client, explaining the rationale behind the recommended coverage and any limitations. Finally, ensure all advice and recommendations are documented, demonstrating adherence to regulatory requirements and professional standards. Question 17. Compliance review shows that a new offshore wind farm project is facing potential delays due to concerns raised by local fishing communities regarding the impact of subsea noise pollution on marine life and their livelihoods. The project's initial environmental impact assessment, IA, identified noise as a risk but proposed mitigation measures that are considered standard industry practice, but may not fully satisfy the specific concerns of the fishing community. The project manager is pushing for a swift resolution to avoid further cost overruns. Which of the following approaches best addresses the situation from a regulatory compliance and risk management perspective for an energy risk and insurance specialist, ERIS, operating under UK regulations and SISI guidelines? Option A. Immediately implement the proposed standard mitigation measures and inform the fishing communities that these are industry standard and legally compliant, focusing on expediting the project timeline to minimize financial losses. Option B. Advise the project manager to offer a one-time compensation package to the fishing communities to settle their concerns and allow the project to proceed without further environmental studies or regulatory engagement. Option C. Commission an independent, in-depth study on the specific subsea noise impacts on the local marine ecosystem and consult directly with the fishing community's representatives to understand their detailed concerns, while simultaneously seeking clarification from the Marine Management Organization, MMO, on the interpretation of relevant environmental protection legislation. Option D. Recommend deferring the project until a later date when technological advancements might offer more effective noise reduction solutions, citing the current uncertainty and potential for future regulatory changes. Correct answer is A. Immediately implement the proposed standard mitigation measures and inform the fishing communities that these are industry standard and legally compliant, focusing on expediting the project timeline to minimize financial losses. Explanation. This scenario is professionally challenging because it requires balancing the immediate financial pressures of a project with long-term environmental compliance obligations, which can have significant reputational and legal consequences. The specialist must navigate complex environmental regulations and stakeholder expectations, ensuring that risk mitigation strategies are not only cost-effective, but also legally sound and ethically responsible. The correct approach involves proactively engaging with regulatory bodies and affected stakeholders to understand and address potential environmental liabilities. This demonstrates a commitment to compliance and responsible corporate citizenship, which is crucial for maintaining operational licenses and public trust. Specifically, consulting with environmental legal counsel and relevant regulatory agencies to interpret and apply the applicable environmental laws and guidelines for the energy sector is paramount. This ensures that all identified risks are assessed against the precise legal standards and that mitigation plans are designed to meet or exceed these requirements, thereby preventing future penalties and reputational damage. An incorrect approach would be to solely rely on internal risk assessments without external validation from legal experts or regulatory bodies. This risks misinterpreting complex environmental legislation, leading to non-compliance and potential fines or operational disruptions. Another incorrect approach is to prioritize cost savings over thorough environmental due diligence, such as deferring necessary remediation or investing in substandard pollution control technology. This not only violates environmental laws, but also exposes the company to significant long-term liabilities and reputational harm. Finally, ignoring or downplaying stakeholder concerns regarding environmental impact, even if seemingly minor from a purely technical standpoint, can lead to significant public opposition and regulatory scrutiny, jeopardizing project viability. Professionals should adopt a decision-making framework that begins with a comprehensive understanding of the relevant regulatory landscape. This involves identifying all applicable environmental laws, permits, and reporting requirements. Subsequently, a thorough risk assessment should be conducted, considering potential environmental impacts and liabilities. Crucially, this assessment must be reviewed and validated by qualified legal counsel specializing in environmental law, and where appropriate, discussed with regulatory agencies. Stakeholder engagement should be an ongoing process, ensuring that concerns are heard and addressed. Finally, mitigation strategies should be developed and implemented with a clear focus on compliance, long-term sustainability, and ethical responsibility, rather than short-term cost reduction. Question 18. Governance review demonstrates that a major energy producer has implemented significant operational changes to its offshore platform, including the introduction of new drilling technologies and a revised maintenance schedule, which could potentially alter the risk profile of its insured assets. The relevant reinsurance agreements contain clauses requiring prompt notification of any material changes to the insured operations. The ERIS is tasked with determining the appropriate course of action regarding notification to the reinsurers. Option A. Proactively engage with the reinsurers to clarify the scope of reporting obligations and seek agreement on the interpretation of material changes as defined within the reinsurance contract, ensuring all relevant details of the operational changes are communicated. Option B. Conclude that the operational changes are not material enough to warrant notification, as they are standard industry advancements and do not fundamentally alter the core business operations. Option C. Provide a general notification to reinsurers stating that operational adjustments have been made without detailing the specific technologies or schedule changes to avoid unnecessary concern. Option D. Delay notification until a claim arises that is directly related to the new technologies or maintenance schedule, to assess the impact before informing the reinsurers. The correct answer is A. Proactively engage with the reinsurers to clarify the scope of reporting obligations and seek agreement on the interpretation of material changes as defined within the reinsurance contract, ensuring all relevant details of the operational changes are communicated. Explanation. This scenario is professionally challenging because it requires the ERIS to navigate the complex interplay between a settant's internal risk management processes and the contractual obligations and expectations of reinsurers, particularly concerning the disclosure of material information. The ERIS must balance the settant's desire to maintain operational flexibility with the reinsurer's fundamental need for accurate and complete information to to underwrite and price risk effectively. The challenge lies in interpreting what constitutes material information in the context of a specific reinsurance agreement and the evolving risk landscape of the energy sector. The correct approach involves proactively engaging with the reinsurer to clarify the scope of reporting obligations and to seek agreement on the interpretation of material changes as defined within the reinsurance contract. This demonstrates a commitment to transparency and good faith, which are foundational principles in insurance and reinsurance relationships. Specifically, adhering to the notification clauses within the reinsurance agreement and seeking a joint understanding of what triggers a reporting obligation aligns with regulatory expectations for sound risk management and fair dealing. This proactive communication ensures that the reinsurer is kept informed of significant developments that could impact the underlying risk portfolio, allowing them to adjust their own risk exposure or pricing accordingly, thereby preventing potential disputes or coverage denials. An incorrect approach would be to unilaterally determine that the operational changes are not material and therefore not reportable. This fails to acknowledge the reinsurer's right to be informed of changes that could affect the risk they have assumed. Regulatory frameworks often emphasize the duty of utmost good faith, and withholding information that a reinsurer might reasonably consider material constitutes a breach of this duty. Such a failure can lead to the reinsurer voiding the contract, denying claims, or imposing penalties, all of which have significant financial and reputational consequences for the cedent. Another incorrect approach would be to provide a vague or incomplete notification to the reinsurer, hoping it satisfies the reporting requirement without fully disclosing the nature and potential impact of the changes. This approach undermines the principle of transparency and can be seen as an attempt to circumvent the spirit, if not the letter, of the reinsurance contract. Reinsurers rely on accurate information to assess their exposure, and incomplete disclosures prevent them from doing so effectively, potentially leading to underpricing of risk and financial strain for the reinsurer, which in turn can destabilize the market. A third incorrect approach would be to delay notification until a claim arises that is directly related to the undisclosed operational changes. This is a reactive and potentially deceptive strategy. Regulatory bodies and industry best practices strongly discourage such behavior, as it erodes trust and can be interpreted as fraudulent misrepresentation. The purpose of notification clauses is to allow the reinsurer to assess and manage their risk before a loss occurs, not to be informed after the fact when their options for mitigation are severely limited. The professional decision-making process for similar situations should involve a thorough review of the specific reinsurance contract's notification clauses. If ambiguity exists regarding what constitutes a material change, the ERIS should initiate a dialogue with the reinsurer to seek clarification and reach a mutual understanding. This proactive engagement, documented appropriately, is crucial for maintaining a strong and compliant reinsurance relationship. The ERIS should always err on the side of transparency when in doubt, as the consequences of non-disclosure or misrepresentation are far more severe than the administrative effort of providing timely and accurate information. Question 19. Consider a scenario where an energy supplier, which also has a regulated distribution network operation, is preparing new marketing materials and customer contracts for its retail energy products. The supplier has historically provided a single set of terms and conditions that broadly cover both distribution and retail aspects. However, recent regulatory guidance has emphasized the need for greater clarity and separation of responsibilities between distribution network services and retail supply services for consumers. Which approach best ensures compliance with regulatory requirements for distribution and retail operations? Option A. Develop distinct sets of terms and conditions and customer-facing communications for distribution network services and retail supply services, clearly outlining the responsibilities, charges, and complaint procedures for each, and ensure these are easily accessible to consumers. Option B. Rely on the regulated distribution network operator's standard disclosures to cover all distribution-related information and only focus on retail supply terms in the customer contracts. Option C. Continue to use a single, consolidated set of terms and conditions that broadly covers both distribution and retail functions, assuming consumers will understand the distinction based on general market knowledge. Option D. Focus marketing materials on the benefits of the retail energy product and include a brief, general disclaimer about distribution network charges without detailing specific responsibilities or service levels. The correct answer is A. Develop distinct sets of terms and conditions and customer-facing communications for distribution network services and retail supply services, clearly outlining the responsibilities, charges, and complaint procedures for each, and ensure these are easily accessible to consumers. Explanation. This scenario presents a professional challenge because it requires navigating the complex interplay between energy market liberalization, consumer protection regulations, and the specific disclosure obligations placed upon energy suppliers regarding their distribution and retail operations. The core difficulty lies in ensuring that all necessary information is communicated to consumers in a clear, accurate, and timely manner, as mandated by regulatory frameworks designed to foster fair competition and informed consumer choice. Misinterpreting or neglecting these obligations can lead to regulatory sanctions, reputational damage, and a loss of consumer trust. The correct approach involves a comprehensive review of all customer-facing communications and contractual agreements to ensure they accurately reflect the distinct roles and responsibilities of the distribution network operator, DNO, and the retail supplier, particularly concerning service levels, pricing structures, and complaint handling procedures. This approach is right because it directly addresses the regulatory requirement for transparency and clarity in the energy retail market. Specifically, it aligns with the principles of consumer protection legislation that mandates clear disclosure of terms and conditions, and the separation of services to prevent confusion and ensure consumers understand who is responsible for different aspects of their energy supply. Adhering to these principles is a fundamental ethical and regulatory obligation for any entity operating within the energy distribution and retail sector. An incorrect approach would be to assume that a single, generic disclosure covering both distribution and retail functions is sufficient. This fails to acknowledge the distinct regulatory frameworks and consumer rights associated with each function. The regulatory failure here is a lack of specificity and clarity, potentially misleading consumers about who is responsible for network issues versus billing or supply contracts, thereby violating consumer protection laws that demand clear delineation of responsibilities. Another incorrect approach would be to prioritize marketing messages over regulatory disclosures, downplaying or omitting critical information about distribution network charges or service level agreements in favor of promotional content. This represents a significant ethical and regulatory failure by actively obscuring important consumer information, potentially leading to consumer detriment and breaches of fair trading regulations. A further incorrect approach would be to rely solely on the DNO's standard disclosures, without tailoring them to the specific retail product being offered. This overlooks the retail supplier's own regulatory obligations to provide clear and accurate information about the energy product itself, including pricing, tariffs, and any associated service commitments, thereby failing to meet the comprehensive disclosure requirements for retail energy services. The professional decision-making process for similar situations should involve a proactive and meticulous review of all customer touchpoints. This includes understanding the specific regulatory mandates for both distribution and retail operations within the relevant jurisdiction, conducting thorough internal audits of all communications and contracts, seeking legal and compliance advice when in doubt, and prioritizing consumer understanding and protection above all else. A robust compliance framework that emphasizes transparency and accuracy is essential for maintaining regulatory adherence and fostering consumer confidence. Question 20. The audit findings indicate that the company's current systems for monitoring and reporting greenhouse gas emissions from its North Sea oil and gas operations are not fully aligned with the latest UK regulatory requirements for Scope 1 emissions, specifically concerning the accuracy and granularity of methane release data. The ERIS is tasked with recommending an implementation strategy to address these findings. Which of the following implementation strategies best aligns with the ERIS professional responsibilities and the regulatory framework governing energy companies in the UK? Option A. Request a temporary waiver from the regulatory body based on the complexity of the existing infrastructure and the potential cost of upgrades, while initiating a review of less stringent reporting standards that might be applicable. Option B. Focus solely on updating the company's internal reporting templates to reflect the new data requirements, assuming that operational teams will adapt their data collection methods accordingly without explicit guidance or system changes. Option C. Engage a third-party consultant to conduct a high-level assessment of the findings and provide a report on potential solutions, deferring any significant investment in new technology until the consultant's recommendations are finalized and approved by senior management. Option D. Immediately implement a new, comprehensive emissions monitoring system across all North Sea platforms, prioritizing advanced sensor technology and real-time data aggregation, with a phased rollout over the next 18 months, accompanied by a detailed training program for operational staff. The correct answer is D. Immediately implement a new, comprehensive emissions monitoring system across all North Sea platforms, prioritizing advanced sensor technology and real-time data aggregation, with a phased rollout over the next 18 months, accompanied by a detailed training program for operational staff. Explanation: this scenario is professionally challenging because it requires the ERIS to navigate the complex interplay between evolving regulatory requirements for fossil fuel emissions reporting and the practical implementation challenges faced by an energy company. The pressure to demonstrate compliance while managing operational realities necessitates a nuanced understanding of both the letter and spirit of the regulations. Careful judgment is required to balance the need for accurate and timely reporting with the potential costs and operational disruptions associated with implementing new monitoring and control technologies. The correct approach involves a proactive and collaborative strategy that prioritizes understanding the specific requirements of the relevant regulatory framework, likely the UK's environmental regulations and potentially specific industry codes of practice overseen by bodies like the CISI if the company is listed or operates within their purview. This approach necessitates engaging with operational teams to assess current capabilities, identifying gaps in data collection and reporting, and developing a phased implementation plan for necessary upgrades. The justification for this approach lies in its alignment with the principles of robust risk management and regulatory compliance. By thoroughly understanding the regulatory obligations and proactively addressing implementation challenges, the company minimizes the risk of non-compliance, potential fines, and reputational damage. This also demonstrates a commitment to environmental stewardship, a key ethical consideration for specialists in this field. An incorrect approach would be to dismiss the audit findings as mere administrative hurdles without a thorough review of the underlying regulatory obligations. This failure to engage with the specifics of the regulatory framework would be a direct contravention of the ERIS duty to ensure compliance. Another incorrect approach would be to implement superficial changes that do not address the root causes of the audit findings, such as merely adjusting reporting formats without improving the accuracy of the underlying data. This would be a failure of professional due diligence and could lead to continued non-compliance. A further incorrect approach would be to prioritize cost-cutting over compliance, opting for the cheapest solutions that do not meet the regulatory standards. This would be an ethical failure, potentially exposing the company to significant penalties and reputational harm, and demonstrating a lack of understanding of the specialist's role in safeguarding the organization. Professionals should adopt a decision-making framework that begins with a comprehensive understanding of the applicable regulatory landscape. This involves identifying all relevant legislation, guidelines, and industry standards. Following this, a thorough assessment of the current operational state against these requirements is crucial. The next step involves identifying discrepancies and potential risks, followed by the development of a strategic plan that outlines specific actions, timelines, and resource allocation. This plan should be developed in consultation with relevant stakeholders, including operational, legal, and compliance departments. Finally, continuous monitoring and review are essential to ensure ongoing compliance and adapt to any changes in the regulatory environment.